Be Wealthy and Smart, episode 777.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about 6 quality dividend stocks. Now, this is something that a lot of people have been asking about. Where are the high dividend stocks that are not too risky, those that are not likely to discontinue their dividend or to cut their dividend? As you know, we love the Dividend Aristocrats ETF, symbol NOBL. However, it had a lot of problems this year. It's not one that I've personally been invested in, but it is one that we've followed on the podcast for quite a while as one that has reliable companies that have a history of increasing their dividends. This year, though, because so many companies fell into financial difficulty, many companies had to cut or eliminate their dividends altogether. So a lot of people have been asking, what are the companies that still have good dividends and are not likely to have to cut them in the future? Well, that's why this article really caught my attention. It's from CNBC.com and it's called Wall Street's Best Performing Analysts Have a Strong Buy Rating on These 6 Dividend Stocks. So I wanted to share these with you and a little bit about their research. It says dividend stocks are a critical part of an investor's portfolio. They are also perfect for market volatility because investors can reap returns even with choppy stock performance. However, knowing which dividend stocks to choose means taking note of both the company's dividend yield and payout, as well as checking whether the stock itself represents a compelling investing opportunity. This is important because a healthy company is less likely to slash or even suspend its dividend payments. One way to find quality dividend stocks is to see which stocks the analysts with the strongest stock picking skills are betting on. TipRank's analyst forecasting service attempts to pinpoint Wall Street's best performing analysts. These are the analysts with the highest success rate and average return measured on a one-year basis, factoring in the number of ratings made by each analyst. This means you can pinpoint dividend stocks with the most bullish outlook based on the latest recommendations from best performing analysts. Indeed, the dividend stocks covered below all score a strong buy street consensus based on ratings published over the last 3 months. Here are the best performing analysts' 6 favorite dividend stocks right now. Number 1, TC Energy. TC Energy's assets include natural gas pipelines, oil pipelines, power generation, and natural gas storage. The company has more than 92,600 kilometers of natural gas pipelines, 4,900 kilometers of oil pipelines, 650 BCF of gas storage, and 4,000 MW of power generation. TRP currently boasts a 5.02% dividend yield, with the next quarterly payout set for 0.604 cents. Looking forward, TRP expects annual dividend growth of 8 to 10% in 2021 and 5 to 7% thereafter. That follows an 8% increase in February, equivalent to $3.24 per common share on an annualized basis. We expect TC Energy to outperform other energy infrastructure companies in our coverage universe, cheers RBC's Robert Kwan. Excluding larger growth initiatives, e.g. Keystone XL, TC Energy remains confident in its ability to grow its annual earnings in the 5 to 7% range based on investing roughly $5 billion per year of capital. I believe that Keystone XL is referring to the Keystone Pipeline. The article goes on to say, and that's with the stock trading at an approximate 20 to 25% discount on a price to earnings basis to premium valued Canadian regulated utility stocks. Plus, Quan sees upside optionality for growth from Keystone XL if the pipeline ultimately comes into service. Alternatively, we see the potential for eventual upside if the stock in Keystone XL is canceled or mothballed, as it would remove headline risk associated with the project, he says. In total, TC Energy has received 3 recent buy ratings from top analysts versus just 1 hold rating. The $56 average analyst stock price forecast translates into a 23% upside potential, with Quan reiterating its $61.52 price target on September 11th. Okay, so basically they're saying it has a healthy dividend, it has good prospects going forward, and they're seeing some upside potential on the stock price as well. The second pick is Johnson & Johnson. Healthcare giant Johnson & Johnson is in the headlights right now thanks to its coronavirus vaccine trials, but the stock is also worth paying attention to for its attractive dividend. A dividend king, Johnson & Johnson pays out a quarterly dividend of $1.01 with a 2.73% yield and 58 straight years of dividend increases. Most recently, in April, Johnson & Johnson, symbol JNJ, declared a 6.3% increase in the quarterly dividend rate, with the CEO highlighting the company's strong financial position and the board's confidence in J&J's future. Credit Suisse analyst Matt Miksic has a buy rating on J&J and a $163 price target. According to the analyst, J&J's pharma franchises are less affected by the coronavirus than device businesses, which are more directly tied to elective procedures. This makes the stock attractive for investors concerned about the potential resurgence of the coronavirus infections and its impact on elective surgery trends. Based on our analysis of price-adjusted scripts and rebate-adjusted sales for J&J's largest U.S. pharma franchises in July, the business appears to be tracking roughly in line with our estimates for Q3, he says. Meanwhile, J&J is enrolling patients for its coronavirus Phase 3 vaccine study, which could include up to 60,000 participants in nearly 180 sites across the U.S. and other countries. All 5 top analysts covering the stock rate J&J a buy, adding up to a bullish strong buy consensus. Meanwhile, the average analyst price target stands at $167, indicating further upside potential of 11%. Shares are currently trading up 3% year to date. Okay, so that was a great summary on the prospects of J&J, and it sounds like if they are successful with this vaccine study, there could be further upside that isn't even priced into the stock yet. So I'd say there's probably a lot more upside potential than just 11%. But J&J's been a steady performer. This long track record of being able to increase their dividend is impressive. And it's one of my favorite dividend companies because of its consistency. Number 3, Broadcom. Semiconductor builder Broadcom is a top dividend stock poised to outperform. It pays its shareholders a quarterly dividend of $3.25 on a 3.61% dividend yield, adding up at a $13 annual dividend, and is currently tracking 9 years of consecutive dividend growth. We continue to see AVGO as well positioned, driven by 5G networking and wireless, software M&A, strong FCF, and dividends potentially moving to about $14 a share by mid-end, with near-term COVID-19 headwinds subsiding, cheered Mizuho Securities analyst Vijay Rakesh. He bumped up his price target on September 4th from $350 to $390 after Broadcom reported an earnings beat on strong demand from cloud data center and telecom service providers. Looking forward, AVGO is now guiding for a robust October quarter at $6.4 billion versus consensus of $6.2 billion. Indeed, as Charter Equity's Edward Snyder notes, the push out of the 5G iPhone ramp and additional RF and Wi-Fi content should deliver 50% sequential growth in wireless revenue in October. We believe the launch of next-generation switching, routing, and Wi-Fi 6 products have kicked off a multi-quarter upgrade cycle at both cloud and service providers, said Schneider. Out of 24 best-performing analysts covering AVGO in the last 3 months, 21 called the stock a buy, with just 3 analysts staying sidelined. That gives the stock a strong buy consensus. Their average stock price forecast of $405 translates into 10% upside potential, with shares already up 17% year to date. Number 4, Home Depot. Home Depot offers shareholders a lucrative yield of 2.17% with a quarterly cash dividend of $1.50 a share. Most recently, Home Depot paid its dividend on September 17th to shareholders of record on September 3rd, marking the 134th consecutive quarter the company has paid a cash dividend. Top Wells Fargo analyst Zachary Fadum recently reiterated his Home Depot buy rating and $310 price target after the company exceeded heightened Q2 expectations. Home Depot, symbol HD, delivered record-breaking results driven by heightened category demand and a new stay-at-home lifestyle. Most impressively, online sales growth accelerated to over 100% year-over-year growth as an increase. Following the results, the analyst noted that a robust start to Q3 bodes well, and the second half consensus likely proves conservative third quarter and fourth quarter comps up 6% and up 4%. With strong third quarter to date trends and favorable category tailwinds, he raised his fiscal year 2021 earnings per share estimate by 8 cents to 7 cents to $11.33, and for 2021, $11.77 on August 18th. All in, Home Depot is proving out the power and sustainability of its model, and in a market that remains supportive of long-term winners, we see few reasons to shy away from Home Depot's accelerating share gains, offensive-defensive characteristics, and strong balance sheet, applauds Fadum. Shares in the home improvement retailer have surged 30% so far this year, but analysts see further upside potential ahead. With 15% top analyst buy ratings versus 4 hold ratings, Home Depot boasts a strong buy street consensus and $310 average price target. Number 5, CVS. Drugstore chain and healthcare services company CVS, symbol CVS, is worth keeping an eye on right now. It coughs up a quarterly dividend of 50 cents with a generous 3.48% dividend yield. And while it hasn't increased its dividend recently, CVS does have a relatively low PE ratio of 9.06%. CVS continues to deliver solid results across the diversified portfolio of businesses that position it well as a leader in transforming the delivery of care, says RBC Capital analyst Anton Hai. With the core earnings trajectory still on track, he reaffirmed his buy rating, saying the company will become a core holding for healthcare investors. Shares are currently down 22% year to date, and Hai sees this as an attractive opportunity, arguing that the market is undervaluing the growth that should become more evident in the coming years. Similarly, Bank of America Merrill Lynch analyst Michael Cherney reiterated his buy rating post-print, explaining, sticking with the guidance should be enough for the stock at a time when the company is also dedicating extra resources to manage the COVID-19 pandemic. He praised the company's improving enterprise profitability, incredibly healthy free cash flow, and discounted valuation. The U.S. healthcare giant has scored 5 recent buy ratings from best performing analysts. Just one top analyst is staying on the sidelines. Meanwhile, the $91 average analyst stock price forecast indicates significant upside potential of 56%. And here's our final recommendation from these best performing analysts: Medical Properties Trust, a real estate investment trust, REIT, that acquires and develops healthcare facilities. MPW has a unique investment strategy, and it is the only public healthcare REIT that solely focuses on investing in traditional and specialty hospitals. As of the first quarter of 2020, the company has about $16.5 billion of total pro forma gross assets, with general acute care hospitals accounting for 84.6% of revenue. It pays out a quarterly dividend of 27 cents on a high 5.93% yield and 5 consecutive years of dividend growth. Stifel Nicolaus analyst Stephen Maneker has just resumed coverage of MPW with a buy rating and $21 price target, telling investors that he expects a growing dividend over the next few years without undue risk. As RBC Capital's Michael Carroll writes, the portfolio should deliver stable, healthy, organic growth as the in-place rents are well protected by solid underlying lease coverage ratios. Indeed, the company has held up well during the pandemic and expects to collect 98% of contractual rent in 2020, with 2% collected at a later date with interest. This stability has helped the company maintain its superior cost of capital, allowing management to continue to pursue new investments, says Carroll. He sees solid, high single-digit earnings growth over the next few years and bumped up his price target from $21 to $22 on August 14th. Overall, 6 top analysts have recently rated MPW a buy, with just one hold rating in the last 3 months. The average analyst price forecast from these best-performing analysts works out at $21.29, a 16% increase in upside potential. End of article. So again, just to summarize, these are 6 dividend-paying stocks. The first was TC Energy, symbol TRP, currently a 5.02% dividend yield. Next is Johnson & Johnson, symbol JNJ, currently paying a 2.73% yield. Number 3 is Broadcom, symbol AVGO, with a 3.61% dividend yield. Number 4 was Home Depot, symbol HD, with a 2.17% quarterly cash dividend. Number 5 was CVS, symbol CVS, with a 3.48% dividend yield. And finally, Medical Properties Trust, symbol MPW, and has a 5.93% dividend yield. So again, no guarantee. These are some of Wall Street's top analysts recommending these 6 dividend-paying stocks. And in this environment, it has been very challenging to find companies like this. So make sure to do your own research before investing. Don't take this as an investment recommendation. I will post a link to this article in the show notes so you can take a look at it, reread it if you like, and see what these analysts have to say. The article does link to each company's website, so that would allow you to do some additional research fairly easily as well. If you haven't yet subscribed to Be Wealthy and Smart, hit the subscribe button and you'll be notified as soon as new podcasts are available so you never miss one of them. And on my website at lindapjones.com/podcasts is my whole wealth mentoring library full of podcasts so that you can learn on whatever topic you want. There's a search bar there. You can put in keywords, find your topics, and get free financial education. And while you're there, sign up for my email list at lindapjones.com. Each week I give a short market update and financial information. I think you'll enjoy that. If you like the podcast, you'll love getting my emails once a week. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.